How does disability income affect taxes? Have you ever wondered how disability income impacts your taxes? This is an important topic for individuals with disabilities and their families, especially when planning for the future. Let's break it down together. First, it is essential to know that not all disability income is treated the same way when it comes to taxes. The taxability of these payments depends on where the income comes from and how it is paid. If you receive disability income from your employer, such as a disability pension or payments from a plan funded by your employer, these payments are generally taxable as wages. This continues until you reach the minimum retirement age. Once you hit that age, these payments are usually taxed as pension or annuity income. So, you will report these payments as wages on your tax return until you reach that age, and after that, you will report them as pension or annuity income. Now, let's talk about private insurance. If you receive disability benefits from a private insurance policy that you paid for with after-tax dollars, those benefits are typically not taxable. However, if your employer paid the premiums for your disability insurance, then any benefits you receive are generally taxable. When it comes to Social Security disability benefits, the rules are a bit different. If Social Security disability is your only source of income, your benefits are usually not taxable. However, if you have other income sources like wages, interest, or dividends, your Social Security disability benefits may become partially taxable, depending on your total income level. There are also tax credits and deductions available for individuals with disabilities. For instance, the federal credit for the elderly and disabled may be available if you are permanently and totally disabled and meet specific income requirements. Additionally, if you pay someone to care for yourself or a family member with a disability so you or your spouse can work, you may qualify for the child and dependent care credit. From the perspective of estate planning, it is vital to consider how disability income will be taxed when structuring an estate, creating a will, or setting up a trust. If a trust is established to provide for a person with a disability, the tax treatment of income distributed from the trust will depend on the type of trust and the source of the funds. Special needs trusts are often used to maintain eligibility for government benefits while providing extra support. These trusts must be carefully structured to avoid negative tax consequences. State laws may also offer additional tax relief, such as property tax exemptions or deferrals for individuals with disabilities. It is a good idea to check local regulations to see what benefits may be available. In summary, disability income can be taxable or not taxable depending on its source and how it is paid. Understanding these rules helps individuals with disabilities and their families plan more effectively for their financial future, especially when considering estate planning and the use of trusts. Proper planning can help minimize tax liability and maximize available benefits.